Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of February, with the majority of economists expecting Canada's inflation rate to come in at 3.1%. We got our answer at 8:30 this morning when Canada's inflation rate came in much lower than expected, coming in at 2.8%.
I feel vindicated.
Indeed, this was definitely good news for Canadians, as economists had expected the return to a 2% inflation rate to be a bumpy ride, as higher energy costs hamper the Bank of Canada's ability to cut rates. And while the surprisingly good inflation data that we received today will no doubt lead to calls for the Bank of Canada to cut rates tomorrow, hotter than expected inflation data coming out of the US are likely to complicate any efforts on the part of the Bank of Canada to cut rates in the next few months. So what I want to do today is go over Canada's inflation data for the month of February, take a look at those factors emanating out of the US which could complicate the Bank of Canada's job, and then discuss some implications going forward. The Bank of Canada's own interest rate decision is due out in a couple of weeks, and we'll obviously have an update out on that decision and the following press conference on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. As mentioned, Canada's inflation rate came in at a surprising 2.8%, led in large part by disinflation in cellular services, food purchases, and internet access. The major contributors pushing prices up were mortgage interest costs, rent, food, electricity, and auto insurance, while telephone services, internet, homeowners replacement costs, meaning home prices, natural gas, and men's clothing led the decline. And the really good news is that core inflation, those measures of inflation that the Bank of Canada uses when deciding whether or not to cut rates, also came in much lower than expected, with CPI median moving from 3.3 to 3.1 and CPI trim coming down from 3.4 to 3.2. And the slower than expected core inflation rate in February makes the outlook for a potential June rate cut at least a little better, as core inflation since June of last year is now sitting at about 2%. So if prices don't go up at all between now and June, then core CPI will be sitting right around that 2% level.
And then there'll be nowhere to hide.
Bond yields fell in the immediate aftermath of the release of the data, though still remain elevated compared to where they were last week before the release of the hotter than expected inflation data coming out of the United States. As mentioned, bets are being pared back that the Federal Reserve is going to be able to cut rates in short order this year. Well, in December of 2023, bets were coming in that the Fed would cut rates 6 times, and the Fed said they'd be cutting 3. Those rate cut bets are being seriously pared back, with some, like JP Morgan Chase, betting that the Fed will only be cutting twice this year. US inflation is proving much more stickier than many had anticipated, and surprised to the upside in February on high rent prices and high gas prices. Though, curious or not, you don't really see calls coming out of the US for the Fed to just stop considering shelter costs, not like we see here in Canada. Though, I suppose the usual suspects in the United States have their own issues to deal with right now.
We don't want to talk about that.
Regardless, escalating inflation in the United States has some predicting that the Federal Reserve is not going to be able to cut rates as soon, as fast, and by as much as many had anticipated. And that could have a real substantial impact on the Canadian economy. The Canadian dollar has been falling over the past week alongside rising treasury yields as demand for Canadian bonds, and thus demand for Canadian dollars, continues to fall relative to that of the United States. US debt, US bonds, at least for now, are seen as the safest debt in the world, and if the US is going to be keeping rates higher for longer, then that is going to increase demand for US dollars to buy those US Treasury bonds, increasing the value of US dollars relative to that of Canadian dollars. So, the US may need to keep interest rates higher for longer, and as a result, that has been putting downward pressure on the Canadian dollar. And this movement in the currency presents a major problem for the Bank of Canada. We are all well aware that the Canadian economy is weakening, and signs of stress abound. Meanwhile, the US economy is doing much better than many had expected, with Jamie Dimon recently calling it kind of booming. So, while the Bank of Canada may want to cut rates, it's going to be constrained if US inflation continues to rise.
It won't.
Were the Bank of Canada to loosen policy, cut rates while the Federal Reserve remained tight, that would put even more downward pressure on our dollar, which would make imported goods even more expensive, which would push up inflation.
All too convenient.
And Deputy Governor Rogers said as much nearly a year ago today.
It is true, if our dollar depreciates, particularly against the currencies of our key trading partners, that means imports coming into the country are more expensive. That can put upward pressure on inflation. If that happens, that'll have to get built into our forecast.
And while this is a problem in and of itself, it's even more so in the context of the upcoming U.S. presidential elections. Some of you may remember that in November of last year, I had noted that the argument being made by the usual suspects, the argument that we were going to see rate cuts because of the U.S. federal election, the argument that the U.S. was going to cut rates because there was an upcoming election, was ridiculous, as there is absolutely no evidence over the past 30 years that the Federal Reserve cuts rates ahead of the presidential election. There is absolutely no evidence to support that argument in Canada either, though I suppose we'll be dealing with that from the usual suspects next spring.
It's in my calendar.
Regardless, the problem facing the Federal Reserve now is that, with rate cut expectations being moved back, in a June cut now only having a 50% probability, the Fed is running out of time to deliver those cuts where they won't be considered political. If we don't see those rate cuts come in June, if U.S. inflation data proves to be continually sticky and the Fed can't cut rates in June, then it only has 2 more meetings prior to the upcoming presidential election in November. And if Powell cuts in either of those 2 meetings, it's going to be seen as highly political. It's going to be seen as a signal of support for the current administration. Now, the extent to which Chair Powell is a fan of either candidate is definitely debatable, but what the central bank does care about is maintaining its independence. More accurately, maintaining the perception of its independence, lest it lose the trust of the people. Fair enough. But again, we can turn to the evidence.
Really?
We can turn to the evidence and see that, with the exception of 2008, where any Fed chairman anywhere would have cut, the Fed hasn't substantially moved rates in the few months leading up to the election in 30 years. And the reason for that is that the central bank does not want to appear to be doing something political. Now, granted, if something big happens, if some great big financial crisis occurs, which isn't out of the realm of possibility, then we could see Fed cuts leading up to the election. But that's definitely difficult to predict. With that said, the Federal Reserve is definitely running out of time to deliver those rate cuts that Canadians are looking for.
I'm a person too, Pop, God. I'm a person too.
Running out of time to deliver those cuts that the Bank of Canada, to a certain extent, needs to see in order for it to comfortably lower rates on this side of the border. Lowering rates without substantially weakening the Canadian dollar, and sending inflation back upwards anyway. With all of that said, good news coming out of Stats Canada this morning. Canada's headline inflation is down. At least for now, we do have carbon tax increases coming down the pike, not to mention instability in the Middle East and elsewhere, but headline inflation is coming down, as is core, all what the Bank of Canada wants to see. With that said, as we can see clear as day in the bond market, the Canadian interest rate story is influenced heavily by exogenous effects, by effects coming out of the United States, which are going to have an even bigger impact on our own economy, on our own central bank, than our own inflation rate or our own economic development. We will continue to track developments coming out of the US on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.